What's up everyone, it's Scotty with MoneyVest. So this is going to be one of those psychological educational videos that I'm going to go over the role of luck in this video when it comes to investing. And this was a very specific topic covered in the book Most Important Thing by Howard Marks. So we are continuing on our series where we break down these small nuggets, psychological factors that can help you in your investing journey as well. I've got a full book review coming out on that book on the MoneyVest Reads channel later this month. I'm just looking for editors because editing takes a lot of time for those specific videos. So hopefully it will be released before the end of this month, but wanted to take one chapter out of that book and break it down for you guys in this video. So hope you guys enjoy it, find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, everything's going to be included, as well as the members only private videos. I opened up 2 more spots if you're interested in joining and getting the 16% annual discount that does expire at the end of this month as well. So 3 to 4 days left if you want to take advantage of it. Link's going to be down below. So when it comes to investing, Howard Marks basically says that it is very difficult, right? When it comes to investing, it's incredibly difficult to basically distinguish between what is luck and what is skill. And the reason for that is because sometimes someone makes a super heavy bet on one idea or one stock, and it ends up in their favor. It ends up actually playing out, and they look like a genius, right? Now, who comes to mind when you think about that for a second, right? Cathie Wood obviously comes to mind because obviously she called out Tesla way before anybody even saw the potential, and Tesla ended up going parabolic to thousands of dollars on a pre-split basis. And of course, during that time, during 2020, 2021, she was kind of hailed as one of the greatest investors of all time. I mean, she's a genius. She saw what other people didn't see at the time, and she was kind of claimed to be one of the best investors of all time. Of course, over time, what happened, right, that was a strategy that was very much dependent on the macro factors. As interest rates started to go higher in 2022, we've seen what's happened with ARK Invest and ARKK ETF. Now, that's just one of the examples. I'm not here picking on Cathie Wood, but in Howard Marks's book, he basically talks about, these are my notes, once in a while, someone makes a risky bet on an improbable and uncertain outcome and ends up looking like a genius because it ends up playing out. But we should recognize the role of luck and differentiate that with skill. And it is so important to do that because much of investing, believe it or not, is influenced by luck or chance of randomness. Now, why would Howard Marks basically say that most of investing is all luck? Like that doesn't make any sense, right? That's because a lot of the decisions that we make, right, the outcomes of those decisions made are not in our control. Listen to that once again, right? The decisions that we make and the outcomes that we are given, they are not perfectly correlated, meaning the outcomes cannot be perfectly tied back to our decisions or actions. And that is because the world is a very chaotic place. It is a very, very there's no mechanism as to how things work, right? There's no system in place. Things are chaotic, right? It is there's a lot of variables at play when it comes to the global markets, right? There's politics, there's economies, there's monetary fiscal policy, there's sentiment, right? There's fundamentals, there's technicals, there's too many things to basically every outcome to be tied back to every decision or action. And that's exactly why a lot of investing is mostly luck. And that's what he talks about in that book. And it says that is because investing, not all our actions can be tied back to our outcomes. Investing is chaotic. There is no orderly fashion in which the markets move, right? There's no mechanism or specific way how the markets move. They can move differently in different circumstances, and there's so many variables at play, right? And he specifically talks about how at the end of the day, when we look at certain gains or we look at the actual monetary value, that can be the same, right? I mean, Cathie Wood making, let's say, $1 billion versus Warren Buffett making $1 billion. They're both the same in terms of monetary value, but there is a subtle difference in how it was actually achieved, right? One can be regarded as luck, another one can be regarded as skill. if we don't make that distinction, we might think that they're both very skillful. And here's a very good example in that book that Howard Marks shares. He says that $10 million earned through a Russian roulette versus $10 million earned through practice of law aren't the same thing, because even though they're identical amounts, monetary value is the same, $10 million for both Russian roulette and the practice of law. The $10 million can buy you the same amount of goods and services. It's the same monetary value, but they are qualitatively different because one of them is straight up through luck and it's not repeatable, and the other one is earned through a skillful practice of the law. And that's where the subtle differences comes in, and that's why it's so difficult in investing for us to really distinguish, even within ourselves, that did I get lucky or am I actually skillful in what I'm actually doing? And Howard Marks basically says that one of the worst measures of skill is short-term gains or short-term losses. And that is so true, because if you really think about, let's say that, you know, you as yourself, let's say that you're judging yourself as an investor, and then you make an investment in, let's say, stock XYZ, and that stock ends up going up 100%, right, in the next 6 months. That's a short-term gain, right? That's a short-term gain. And you might not realize that that was mostly, let's say it was luck that played a significant role in that stock rallying 100%, and you might be misled to believe that you are an incredibly skillful investor. Like, don't get me wrong, you might be. But short-term gains and short-term losses are a very bad indicator to really judge whether the person was skillful or not, right? And we can go the other example as well, right? Let's say that I invest in a stock XYZ and the stock collapses 30% in the next 3 months. And that in itself is not an indicator of sort of my skill level when it comes to investing, right? So that's a very important key takeaway to remember, is short-term gains or losses are not an indicator of whether you are a skillful investor or not, because a lot of things in the short term are driven by luck. And more importantly, the key word here is the best measure of luck is superior risk-adjusted return over time. And over time is the key word here, because it's basically going from short term to long term, right? And that's exactly what happened between Cathie Wood and Warren Buffett, is that you can see Cathie Wood having these years, 1 or 2 years in a 5-year period or 10-year period where she does really well, but then over time, right, it's not that great performance. But Warren Buffett, over longer time frames, we're talking 10, 20, 30, 40, 50 years, has been able to perform really well. And that is a very true measure of skill versus luck, right? We can't say that Warren Buffett got lucky for 50 years, right? That just doesn't sound right. But we can say that Cathie Wood got lucky 1 year because her performance after has been not that great. So that is a very, very important distinction that we need to make, is that the short-term gains and losses are not great measures of skill. And it's a much better measure of skill is long-term performance over time, once it's gone through multiple different, sort of dynamics, environments in the market. Now, this right here is another thing that I wanted to point out, is that oftentimes the luck role plays on a specific stock or an idea, right? So let's say that you have an idea, let's say that you are investing in a stock and you end up making money on it, and that, can be applied to one particular stock or an idea. But when you are measuring skill, it is not so much about stock itself, but it's more about the process of stock selection. That really what it comes down to when it comes to skill versus luck, right? You can get lucky on a stock, but you can't get lucky on a process. A process will determine a skill, right? If you've honed down on, let's say, a system or a process of selecting stocks or selecting real estate or whatever it is that you want to invest in, or whatever it is that your skill level is, it's a process, right? It is not so much of a stock or an idea, right? And I can give you a simple another example that is going to make it a little bit easier to understand. Let's say that you practice law, right? Let's say that you are a lawyer, right? One case doing well or doing worse is not going to determine whether you are skilled at law or not. It's going to be the process at how you approach law and practice law is what's going to determine your skill level, right? It's the same thing. It's a process and system. That's more skilled versus single stock and idea. That's more dependent on luck. So Very important to understand that. And of course, luck can only be applied 1 or 2 times, right? You can only get lucky like once or twice, but consistency is the keyword when it comes to skill, right? You're going to be consistent over the long term. That's how you know that you are skilled at what you do, right? Because again, you go back to the example, let's say that you are a dentist or a doctor, right? When you practice these things, when you practice these disciplines over longer time frames, and you are consistent at what you do, and you're good at what you do over longer time frames, that in itself will tell you that you are skillful in that thing. If you just got lucky once or twice, well, guess what? Third time, fourth time, fifth time, you're not going to get any more clients, you're not going to get any more business, and that's how you're going to know that you're not skillful. Instead, you got lucky. So that's, a very, very important lesson to take away from that book. And this is one of my favorite pages from the book as well. It's on page 135, Appreciating the Role of Luck. And this is such an interesting analogy because what he basically says that, all right, so here's right here. Warren Buffett, appendix to the 4th revised edition of The Intelligent Investor, describes the contest in which each of the 225 million Americans, right, the whole population of the US, starts with $1, right, and flips a coin once a day. So you take a penny, you take a coin, you flip it, right? The people who get it right on the day, one, collect $1 from those that were wrong. So basically what he's saying is that, okay, we start with the entire population of the US, everyone flips a coin and calls it in the air, heads or tails. Whoever is right takes $1 from the person who is wrong, right? And you do that over and over again. 10 days later, 220,000 people have called it right 10 times in a row and have won $1,000. So after 10 times doing that, 220,000 people have called it right in the air, heads or tails, 10 times in a row, and they've won $1,000. They may try to be modest, but at cocktail parties, they will occasionally admit to attractive members of the opposite sex what their technique is and what marvelous insights they bring to the field of flipping. After another 10 days of doing this, we are down to 215 survivors who've been right 20 times in a row. Think about that. 215 people that have called it right 20 times in a row at a flip of a coin, right? Even though we know logically it's a 50-50 chance, right? We know if you call it in the air, heads or tails, it's a 50% chance you're going to be right or wrong. But after 20 times, we start to think what? We start to think that, man, that person's skilled at flipping coins. Whatever they call, they're right, because that's what data suggesting last 20 times they've been right, even though statistically we know it's a 50-50 chance. And of course, this goes on by saying that they write books titled How I Turned $1 into $1 Million in 20 Days Working 30 Seconds a Morning, Selling Tickets to Seminars. Sound familiar? So it is very easy in the markets for us to mistake skill with luck. So we got to be on the lookout. Of course, we got to be skeptical and really understand within ourselves, right? What is our skill level? And that's only going to be determined over long periods of times if you're following a very good process of stock selection, understanding the systems, understanding the mechanisms involved with investing, and not just blindly betting on stocks and hoping you make money. That can only last you maybe once, twice, but long-term success comes with following a trusted, worthy process and system. So hope you guys enjoyed this video. Wanted to do a little bit of an educational video. Again, this book has really changed my life, and it's not an understatement because I highly recommend it to anybody who's wanted to understand the psychology behind investing. There's a couple different books, like obviously I've done a review on the psychology of money as well, but this right here is another one from Morgan Housel. Actually, this is from Daniel Crosby. The foreword is from Morgan Housel, The Laws of Wealth. A little bit more in personal finance, but gets you on the right mindset when it comes to investing, personal finance, and just understanding money. I mean, it's really important. Like lots of people don't understand money, and that's because everyone's grown up with different perspectives around money. So it's really important stuff, obviously. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Again, link to our Discord, Patreon is going to be down below. There is a 16% annual discount available till the end of this month. Make sure that you do join us and, of course, take advantage of that while it's still available. As always, happy investing. I'll see you all in the next video.